People keep arguing about whether the Federal Reserve is independent. That argument misses the point. Independence isn't something that disappears in a press release or gets revoked by a headline. It erodes quietly, the same way credibility erodes in markets, long before anyone is willing to say it out loud. The Fed doesn't lose influence when a politician pressures it directly. That kind of pressure is obvious, and obvious pressure is usually resisted. The real damage happens earlier, when markets start to believe the Fed can't afford to act freely. That belief changes everything. Once investors stop asking, what does the data justify, and start asking, what is politically tolerable, the reaction function shifts, even if the Fed insists it hasn't. Markets don't need proof. They trade on inference. This isn't about conspiracy or control. It's about memory. Markets remember a period when interest rates stopped being a technical setting and became a political talking point, when rate hikes were publicly criticized, when monetary policy was framed as something that could influence public sentiment and electoral outcomes. They remember a president, Donald Trump, who treated interest rates as a visible economic lever, not a background variable. That precedent matters, not because it's repeating in the same way, but because it changed expectations. Once that door has been opened, it doesn't close neatly. So now, when the Fed is facing a slower labor market, inflation that hasn't fully resolved, rising debt service costs, and an unmistakable political calendar, markets don't assume neutrality. They assume constraint. That assumption alone is enough to change behavior. When independence is doubted, markets stop waiting for confirmation. They front-run accommodation, they price cuts earlier, they discount inflation persistence faster than the data justifies. Not because the Fed promised support, but because hesitation is assumed to be expensive. This is the part most people misunderstand. The Fed can still say it's data dependent. It can still publish forecasts and emphasize credibility. None of that matters if investors believe the range of acceptable outcomes is narrowed. Credibility isn't about what you say you're willing to do. It's about what markets believe you'll actually do when it's uncomfortable, and that belief is weakening. You can see it in how quickly markets move ahead of policy, and how easily inflation risks are waved away, and how confidently risk assets assume a backstop that hasn't been explicitly offered. It's not optimism, it's conditional trust. And conditional trust breaks faster than blind confidence ever does. The danger here isn't that the Fed is controlled. That framing's too simple. The danger is that the Fed is perceived as boxed in by labor market optics, boxed in by debt dynamics, boxed in by political timelines. And once markets believe policy is boxed in, they stop treating guidance as guidance. They treat it as constraint management. That's when volatility doesn't show up where people expect it. It migrates, it hides, it concentrates in places that assume stability as a baseline. This is how you get markets that feel calm right up until alignment breaks. Independence doesn't need to be lost for this regime to exist. It only needs to be questioned. But once it is, the burden shifts. The Fed can still move rates. It can still influence liquidity, but it can't control belief. Belief moves faster than policy. Belief prices risk before data confirms it. Belief compresses time. That's the regime we're in. And the investors who struggle most here are the ones who need independence to be absolute, policy to be clean, and outcomes to be linear. The ones who do well are the ones who assume friction, misalignment, and delay is the baseline, and structure accordingly. Because when belief moves faster than policy, clarity always comes too late.